Dennis, welcome to the show. Man, another day, another dollar, so much to talk about. Where do we even start with your vast experience? First of all, welcome to the show.
Thanks, Brad. Thanks for having me. Appreciate it.
Let's jump into this. Why don't we let the listeners know just a little bit about who you are and
Sure.
man, how did you get to where you're at now?
Well, it's a very conventional path actually because I started my career in the real estate space. I started out of college as a housing market analyst, worked my way up the corporate ladder, making a bunch of other people money for 20 something years. Finally got to that, exalted CEO spot and realized that I still had a board of directors and investors, and I really didn't have the freedom or the control that I thought I did in my life. I made a good paycheck, but I was still, my whole focal point was making the company money, not myself money. And so about 5 years ago, I left that position. I started my own investment firm. I've started two other investment firms since then. So the first two were residential oriented, and then my primary focus now, Sentinel Net Lease, is commercial real estate oriented. But I think it's the same thing that a lot of people have in their life. Even if they love what they do, there might be a better way to do it. And so that for me was the jumping off point. I know there's a ton of people that have made an absolute fortune in real estate as a second career. I did pretty good in my first career working for other people, but I really found that I was able to leverage my knowledge and benefit myself directly by starting my own firm and growing my investment platform. And that's where I'm at now. And so my focal point with Sentinel is really to kind of bring Wall Street opportunities to Main Street investors. So using my 25 years of institutional background working for big companies like Lennar and Toll Brothers and Cerberus, and really going and underwriting and finding those opportunities in the market that I think are going to outperform everything else. And so I've been pretty fortunate in the single family space early on, and the build for rent sector, which is purpose-built rental homes, the entire community. And then also successful with commercial real estate over the last several years.
Are you just an investor that's building a team, a company around it? What do you mean by investment firm? What's that
So
mean to you?
yeah, a lot of people are when they make the leap, it's to just go do whatever they're doing full time by themselves. But because my background is working on bigger projects and bigger deals, I didn't want to go do 2 or 3 flips. So the first thing we acquired, it's kind of a little esoteric, but we bought 30 model homes from a home builder, and we did a sale leaseback with them. And so it's kind of an off balance sheet financing solution for the home builder to help their balance sheet. We buy it at a very attractive cap rate, and then we lease it back to them because they need to use it to run the sales for their communities. And that was a $11.7 million transaction. So I certainly wasn't going to be able to fund that by myself. So what I did was, I put together an investment summary. I found a lender to fund the deal, and then I took it to, essentially my network of people I know that like my background. They know what I do, and they were looking for a good alternative to the stock market or some of the other real estate ventures they've got into. And so they invested alongside me as a limited partner. And so that's how I've kind of grown that platform. And so now between, the 3 platforms, we've got big institutional partners, but really we focus on the smaller retail investors, the mom and pop, the doctors, the dentists, the attorneys, things like that, where they don't necessarily have the full time to make that leap, but they want to get started. And so we have about 325 different investors on our platform that up until this point could just basically pick and choose what kind of deals they wanted to invest in, whether it was a residential deal, an office building, a grocery store. But with the way the market's changing now, we're really focused on, we've just launched a fund. And so the fund gives those investors kind of instant diversity because it's spreading that investment across whatever we're going to buy over the next couple of years.
What is the typical time span for the loans? I know it's going to be relative to the property, probably the dollar amount and all of that, but what are some typical loans that you're seeing in these types of investments?
Yeah, so the commercial real estate world's a little different than the resi investment side, especially like flips, right? Which are usually very high leverage and higher cost, but you're making your money on those pretty easily, so you can absorb those high interest rates because it's a short period of time. On the commercial real estate world, these are perm loans. They're typically 5 to 10 years in length. You can do fixed or floating rate. Usually we'll try to close on the property with that financing already attached to it. So we'll close with the financing in tow, so we don't have to put out as much equity. But if we don't, it's the same process. It's just 60 days, 90 days later.
What are some of the areas, two questions here, areas geographically, and then two, the asset type. What type of classes are you excited about right now? Just like how excited you are to strap on your golf shoes and go golfing down there in Mexico. That same kind of excitement. Where are we at?
I'm sadly equally excited about real estate investing as much as I am about golf. So there is a pure passion for what I do.
Yeah.
And that's a great question because I think when you use conventional wisdom, you think of like the biggest cities is where the best opportunities are, right? You think of LA, Miami, New York, Chicago, and in reality, those are some of the most difficult places to make money because they're highly competitive. You're not only dealing with professional investors, you're dealing with amateur investors. You're also dealing with foreign investors in a lot of this market who have completely different return profiles. So geographically, I think there's a tremendous amount of value in the Midwest and the Southeast. A lot of big hedge funds, private equity companies, they just view the entire Midwest as flyover country. And I think they're missing the quality of life and the affordability that a lot of the major cities in the Midwest bring. I mean, you look at, I mean, you can start kind of in Texas. Obviously everyone knows Texas is booming, but it's not just Dallas and Austin. It's, Houston has a tremendous amount of opportunities. San Antonio has been, sneaky strong for the last 5 years and growing very rapidly. I love those markets geographically. The Carolinas offer a lot of opportunities as well. I would steer clear of kind of, Louisiana, Arkansas. Those aren't quite growing quite as fast as some of the other areas in the general regions I talked about. But look, there could be a good market anywhere. I think that's what really separates great investors from bad investors from where the opportunity is if you're just going to put a red flag on an entire area without really knowing it, then that means the next guy might find the good deal that's in that market. So it's definitely worth looking in some of those less publicized metro areas in the Southeast and the Midwest. And then asset class wise, industrial is tough. Multifamily is near impossible to get to a level you want unless you're doing a significant amount of value add. And so I think that's where I would differentiate. There are still good value add multifamily opportunities out there if you're with an experienced operator that knows how to create the lift in rents, knows how to fully stabilize a community, and then puts the right debt in place on it. And then when the market does come around on multifamily and rates compress further, that could be a good opportunity for a pop there.
What are the top 3 KPIs that you look at to say, hey, I like this market?
So I will generally start with population density in an area to make sure that I like that it's a big enough market for me and it's a big enough suburban market. So I could say that, hey, I'm going to go to Chicago, and Chicago's got 8 million people. But if I'm in the wrong area in Chicago that doesn't have a lot of population density, then I don't feel good about the growth in that market. So I'm looking at really a combination of population density and then what that growth looks like over the next 10 years. And so that's an important 1-2 punch. I look at household incomes as another important factor in this because we generally want to be in high quality of life areas. And as you might imagine, the higher the income, the rest of the demographics follow. So generally, if you're in an area with high incomes, you are also in an area with a higher percentage of degrees, a higher overall net worth figure. So it just, when you start with income, it starts to check off all these other boxes from a quality of life perspective. The better schools are in the areas where the higher incomes are. So that's definitely a leading KPI for us. And then ultimately, I would say the third one that we're looking at, depending on what kind of asset we're looking at, is the commute time to, and that's not really a KPI, but it's an important factor, is what are the commute times? What do those look like to the major hubs of activity in that market? So is it an hour from the airport? Is it an hour from downtown? Is it 20 minutes from the best hospital? Those kind of factor to the main commercial services and activity hubs in a market.